You know, for the longest time, the bond market felt like this big guessing game, all about trying to predict what interest rates would do next to score some quick price gains. But for 2026, the entire game has changed. According to some of the heaviest hitters in finance, there's a new king in town. So let's break down what this massive shift in the bond market is all about.
And Vanguard sums it up perfectly in just 3 words. Carry is crowned. So what's carry? It's simply the steady, reliable income you get from a bond's coupon payments. Think of it as the rent you collect for lending out your money. And after years of being on the back burner, this simple, dependable income is now front and center, the main thing driving returns.
And that, right there, is the million-dollar question, isn't it? If income is suddenly the most important thing, how does that change the game plan for you, for your portfolio?
To figure this out, we're going to dive into the 2026 fixed income outlook from 2 of the biggest names out there, Vanguard and Morgan Stanley. And they're both pointing to the exact same thing. So let's get into what they're seeing, and more importantly, why it matters so much right now.
Okay, so before we can really look forward to 2026, we have to rewind the clock just a little bit. Because this whole story really got started with the huge comeback we saw back in 2025.
And what a comeback it was. I mean, this chart from Vanguard says it all. 2025 was just a fantastic year for bonds. Just look at those numbers. U.S. high yield, over 8.6%. Emerging markets, even higher. Pretty much every corner of the bond market was in the green. And the key thing here is that this performance wasn't just about prices going up. It was really driven by those steady, predictable coupon payments. And this, right here, gets to the absolute heart of this whole strategic shift. For so long, it was all about trying to time the market, buy low, sell high. But now the focus is shifting to a much simpler and, frankly, more powerful idea. Just collect the reliable income, the carry, that bonds are actually designed to give you.
This slide is the perfect visual for what Vanguard calls cash dethroned. See that dotted circle there? As the Fed started cutting rates, the yields you could get on super safe cash, like T-bills, started to drop. But look at the other lines, investment-grade corporate bonds, mortgage-backed securities. Their yields held up way better, making them a much more attractive place to be than just sitting on the sidelines in cash.
And if you're thinking, okay, but that was just 1 year, well, this chart proves that 2025 was no fluke. This goes back 2 decades, and the pattern is crystal clear. That top line shows how a hypothetical 10 grand in U.S. credit would have grown to over $22,500, and way down at the bottom, that's cash, which barely got you to $14,000. The lesson from history is pretty obvious. Over the long haul, investing in bonds has paid off handsomely compared to cash. All right, so that's the backstory. That's what got us here. Now let's pivot and look at the road ahead. What kind of economic environment are the experts telling us to expect for 2026?
Well, both Vanguard and Morgan Stanley are actually painting a pretty favorable picture for bonds. They're seeing modest but solid growth in the U.S., inflation continuing to cool off, and a Federal Reserve that's probably going to stay cautious, maybe giving us a couple more rate cuts. You put all that together, steady growth, cooling inflation, and easing policy, and you've got a real sweet spot for fixed income.
Okay, so if the big picture looks good, where exactly do we find the opportunities? Well, according to our sources, a huge part of the answer lies in something called the yield curve. And hey, if the term yield curve sounds a little intimidating, don't worry. It's really just a simple line graph. All it does is show you the interest rates you can earn on bonds with different time horizons, from short term to way out in the long term. And the shape of that line tells you a whole lot.
And this is the curve that has analysts so excited right now. This is from municipal bonds. Just look at that dramatic upward sweep after the 10-year mark. Vanguard points out that the extra yield you're getting to go from a 5-year to a 30-year bond is historically wide. A steep curve like this is basically the market telling you that it's willing to pay you a lot more to lock in your money for longer.
So, that really steep curve leads us right to what both our sources are highlighting as a potential star of the show for 2026. Municipal bonds, or munis for short.
So what's the big deal? Well, how about this number? Roughly 7%. According to Morgan Stanley, that's the tax equivalent yield on a 20-year AA-rated muni bond. That means to get the same take-home return from a regular corporate bond, you'd need to find one with a much higher yield. That's a pretty compelling number.
And this chart from Vanguard just drives that point home perfectly. It shows the extra yield, the yield advantage that munis are offering compared to the broader bond market. And notice how that blue area just gets bigger and bigger the further out you go. For anyone looking for income, especially after-tax income, that's a really powerful picture. So let's just recap Morgan Stanley's case here. It really boils down to three key things. First, those awesome after-tax yields we just talked about. Second, the credit quality is surprisingly solid. We're talking 18 straight quarters of more upgrades than downgrades. And third, they're a great diversifier. They just don't move in lockstep with the stock market.
Okay, so the traditional case from unis is looking really strong. But hold on, because there's this other absolutely massive economic force starting to ripple through the market, and that's the AI investment boom.
Get ready for this number. McKinsey estimates that building out the global AI infrastructure by 2030 is going to cost somewhere between $5 and $8 trillion. I mean, just try to wrap your head around that. It's an almost unimaginable amount of money.
And where is all that cash going to come from? You guessed it. A huge portion of it is going to be raised right here in the bond markets. Vanguard notes that the giant tech companies, the hyperscalers building these massive data centers, issued over $130 billion in bonds in 2025 alone. This tidal wave of new bonds means you have to be selective, but for investors who do their homework, it's creating some incredible new opportunities.
All right, we have covered a lot of ground, from the return of carry to steep yield curves and the AI boom. So let's boil it all down. What does this actually mean for you? Let's create a clear playbook.
Think of this as your 2026 playbook. Step 1. Remember the new mantra. Carry is crowned. Prioritize that steady income stream. Step 2. Look beyond cash. With yields on things like money market funds likely to fall, moving a bit further out on the curve offers better return potential. And finally, Step 3. Be selective. Both Vanguard and Morgan Stanley hammered this point home. This is not a market where you can just buy anything. You have to be smart to find the real winners.
And that really leaves us with the final question. The rules of the game have clearly shifted. The focus is squarely back on income. The experts have laid out the map. The only question left is, what are you going to do with it?